Hey friends, I'm Melody Davis. Thanks for stopping by my channel. Welcome to Greensboro. Like, subscribe, contact me with questions. I'd love to chat with you. I'm actually here today with my buddy RJ Meyerhofer, who's my preferred lender with Rate, and we're gonna do kind of a deep dive into how to buy a home, the types of mortgages they have, that they offer, and so I'm really excited about it. So thank you for being here.
Hey, I'm excited to be here. Thanks for having me.
Absolutely.
I really appreciate it.
Been working with RJ for a while now, and he is fantastic. And we have come across all different types of clients, all different types of needs.
Indeed, yes.
All kinds of scenarios. So I thought it'd be great because I'm an educator also. I'm actually a professor at Elon, and I love to teach. So it's important to me to teach people about getting a home loan, how to buy a house, all those things that we've been talking about. So again, thanks for doing that. So we're gonna pull out the whiteboard today. So it's gonna be a little different than what I normally do.
All right.
So let's start with this. So who is the ideal client to buy a house today in 2026?
I think that number one, that's a great question. But I think if you are, stable in your employment and your income, if you feel like you're going to be in a specific area for, at least the next few years, and you're tired of renting, I mean, anybody that falls into that literally could be a good candidate to buy a home, ultimately.
Okay, do you think there's a certain age? Because oftentimes people ask me, believe it or not, how old do I have to be?
Yeah. Well, you do have to be 18. You've got to be, legal to sign, documents. I don't think that there is like an ideal age range ultimately.
Okay.
I think the last stat that we heard was that the average age of the first-time home buyer now was 38 to 40 years old.
Older.
And so, we work with everybody from, say, their early 20s. I've worked with 70-plus-year-olds. It just depends on where you are in your life and what the need is that you currently have. So, you know what? It doesn't matter about the age.
That's interesting. Okay, so let's recap. They've got to have stable income.
Yes.
A lot of people don't realize that, especially because younger generations too move around a lot more, so that is really, really important. Okay, they're tired of paying rent because we both know that rent is just money you're throwing away. Might as well just flush it down the toilet, right?
Yes.
Got to be 18 years or older. That's good. And then you want to stay in the same area, which again, a lot of younger people don't tend to want to do, right? It's changing. They like to be transient for a while.
Yeah, a lot of the younger people are that way, or they're just not sure how long they're going to be in a particular area. So I think if you felt like I may only be here a year or so, then maybe buying a home is not the right move for you, because you want to have 2 or 3 years or so to at least build some equity and to be in a position to make some money on that sale when you do decide to move.
That's a great point, because very rarely do you make money when you turn around and sell in a year, because you've got to pay agent fees, taxes, because especially, let's just say you did make money, then you're stuck with capital gains, which the federal government will kill you with. And so I have actually turned people away. I've said, don't buy right now. And it kills me to say that, but literally if you're just here for a year, I had a client, they would have a house in Charlotte, they were coming here for a year, and they're like, we'll just buy a house here for a year and go back. And I'm like, you're gonna lose money, unfortunately. So one caveat.
Yeah, the market has shifted a little bit. We're not seeing these huge, spreads of equity that we saw, or the appreciation, from 2020 and 2021. I mean, average appreciation is 4 to 5% annually, which is great. But it's just not enough if you're trying to sell, say, a year after you purchased a home. It doesn't make sense. I agree with you on that.
Okay. So again, you want to be in one place for a while. You have to have stable income. Again, you have to, because they're going to look at your income and how long you've been at your job. Again, that's another thing that especially gets young people, because they're like, well, I started 3 months ago. Talk to us about time frame. How long is ideally to be in the same job?
Well, I think people get a little confused about that. You can have switched jobs, or you could be on a new job in the last few months and still qualify to buy a home. I think where it gets tricky is if you transition from one job to another, and let's say the way you're paid completely changes. Let's say that you were salary, or you were an hourly rate employee, and you switch over to something where it's predominantly bonus or commission income. That's a problem because you don't have the history. And so everything's like in 2 years in mortgages. So if you have income outside, say, an hourly rate or a set salary, like a bonus, commission, overtime, you need to be able to show 2 years of that so the lender can average it and determine, what your true income is. But it is okay to switch jobs as long as you're not completely changing the way you get paid.
That's good. And there's all different types of loans, and we're going to go into some of them today.
Yeah.
But we also know that when you go under contract, again, you've got to put money down. So of course you want to get your lending done on the front end. Try to get everybody pre-approved.
Yes.
Not everybody wants to do that, but I try because again, you don't have any surprises later on. And there's different types of loans, so you have to put money down. There's different types of loans. So we're going to walk through kind of the different type of loan options. Okay.
Perfect.
All right.
Okay.
Because they're different options. So you've been doing mortgages for how long?
33 years.
33 years, and you have seen a lot of different options.
I have, yes. I started out in this industry when subprime lending existed. And now, we went through a cycle after the housing crash in 2008 where credit was very restrictive. It was,
Yeah.
if you didn't fit into that perfect little box, you were not getting financing. But it's really loosened up a lot, especially in the last few years with a lot of additional programs.
Which is good, as long as people can actually afford the mortgage. We don't want people to get into a position where they can't afford
Correct.
it and then they lose their house. Because that's what caused the 2008
Yes.
crisis to begin with. All right, so let's start with FHA.
Okay.
So I have a lot of people that ask me about FHA. So let's talk about it. Give
Okay.
me kind of an overview summary for our people watching.
Okay, perfect. I actually am a big fan of the FHA mortgage. I try to, just really talk in terms that I think people will understand. And I think that, the big thing about FHA is I think it's a little looser, a little less restrictive than conventional financing. It's a little more forgiving, if you don't have, say, a really high credit score. Let's just say that your score is in the 600s. Let's say that your debt to income ratio is a little higher. That really fits so much better into an FHA guideline than a conventional guideline. That program has been around since right after the Great Depression. It was designed to facilitate home ownership in this country. So it is a very flexible program overall. It's a go-to, like I said, for a lot of people who maybe don't have 700s to an 800 credit score, or, for whatever reason, maybe the debt to income ratio is a little higher than what's allowed by conventional loan limits. So yeah, it's definitely a go-to. I would say, and it falls into what we call GOVI or government loans. So that's your FHA, VA, USDA. And I would say, for my business, I'm probably doing 60 to 70% conventional, but probably another 30 to 40% in government loans like FHA.
So FHA is interesting because people that, especially if they're younger, they don't have as much cash.
Correct.
They only require 3.5%?
That's right. It's 3.5% minimum down payment. Another great thing, and we're seeing a whole lot of changes with seller concessions.
Yes, we are.
Here lately.
Yes.
The seller can pay 6% of the purchase price and closing costs.
Which is huge.
So literally all of them, basically. So it is a minimum 3.5% down. That 3.5% down, does need to come from the buyer, but it's really flexible in that way. It could be the buyer's own funds and their checking, savings, maybe their 401k. They can get gift funds from relatives, mom, dad, brother, sister. The lender just has to be able to document where the money's coming from, ultimately. And if we can do that, then it's very flexible on where that required down payment's coming from.
Okay, we're gonna do a summary here, of course.
Okay.
So FHA, again, one of my favorites for especially first-time home buyers.
Yes.
Less restrictive. You can have lower credit typically than, can't have too low, of course, but you can have lower. They're government-backed loans, so again,
Yes.
that they're kind of helping offset the financing, the end of it. 3.5% down, which means again, if you have a purchase price of $200,000, let's say you're buying a home that's $200,000, which is actually really hard to do anymore. That means you have to come up with,
Yeah, it's $7,000 on a $200,000 purchase, 3.5% down, $7,000.
so you've got to have some cash.
You do.
And another thing I think a lot of people forget when they're buying a home is you've got to have money for inspections. And you also have to have money for closing costs if we can't get those negotiated. We always try, because again, like we just said, it's changing to where sellers are having to make concessions to get people to buy their homes. We went from a seller's market back to a balanced market. We're not quite to a buyer's market yet, but we're in a balanced where the good stuff's going fast, but a lot of things that have been sitting a long time, sellers may have to, again, give more incentives to people to buy. So that's really good. Okay, so FHA, again, a great option. Now there is one caveat to FHA.
Okay.
That I don't love. Let's talk about PMI.
Sure. Regardless of the down payment, with conventional loans, when you're putting 20% down, you avoid PMI. And if you're not familiar with PMI or private mortgage insurance, it's just basically an insurance policy for the lender in case you default on the loan. I mean, that's ultimately what it is. It's not doing anything for you as a consumer, but it is part of your mortgage payment. So that does, unless you're putting 10% down on an FHA loan, then that PMI or the mortgage insurance premium will stay on there for the life of the loan.
I hate that for people. So again, it's called private mortgage insurance, PMI for short.
Yes.
Right?
Yes.
Okay.
So that, that will be there if you're, for the life of the loan, if you're not putting down the 10%. What some people will do, if they're starting out maybe with an FHA loan and they've built the equity, if the rates are, agreeable in the future, they may refinance it into a conventional to actually get rid of that PMI. So that's an option as well.
All right, so the next one that you just said you do about 70% of
yes,
are conventional loans. So let's talk about those.
Okay. That ultimately, conventional loans are your traditional Fannie Mae, Freddie Mac mortgages. They're the most common type of mortgage that's done. That is, the type of buyer that fits into that generally does typically have a higher credit score. They're in the 700s to 800 range. They typically do have a down payment and they have good stability within their employment and their income. There's a number of reasons that, you might choose conventional over FHA. But if somebody has, for example, a 780 or higher credit score, and they've got 3 to 5% down at a minimum, there wouldn't be an advantage, unless it was a debt to income ratio issue or something else unforeseen, there wouldn't be a reason to do a government loan on that versus a conventional. But it is, one thing I think that's absolutely misunderstood is that I think a lot of times from the seller's angle, like if they see that the buyer has a conventional loan approval, they automatically think, okay, great, they're more stable, they have better credit, they have the down payment, they're going to be a better qualified buyer than, say, this FHA offer that I have. And that's not necessarily true at all. I've seen that be a misconception for a lot of years. There's many different reasons why people fit into one loan structure or another. That is an unfair, though, assumption that the conventional buyer is cleaner than the FHA
I've heard that a lot from sellers. But it's changed, and even in the past 20 years of my lifetime since I bought my first home at the age of 21, believe it or not. I can look back now and I'm like, boy, I was too stupid to even know how insane I was. But the down payment requirement, so the amount of the percentage for down payment for conventional used to be, it was like 20%. Back in the day, right? If I remember correctly.
I think back, way before our time, which is saying a lot for me because I've been around forever.
Me too.
I think back in the day, and I've done some research on this, I think that very large down payments were the norm, say back in the 50s and 60s.
Because baby boomers were savers.
Right.
Generationally, they were the last generation of savers, actually.
Yes, they actually had large down payments. The 20%, and I know that every realtor and mortgage person that's on social media has done a video about you don't need 20% down, and you don't. Like the minimum for a first-time buyer on conventional is 3%, but I think where the 20% kind of still lingers, out here in our world, is that 20% is the down payment range where you avoid the PMI or the mortgage insurance. That's really the only advantage of obviously you're going to have lower payments, but that 20% just pertains to PMI. That is it.
Right. But again, it's one less thing you don't have to pay because, like you said, you're not benefiting from it as a buyer.
Yeah.
You said 3%. Typically, I use the rule from a 5%. So that's actually interesting that they could do 3%.
Yes.
So let's talk about this. So again, as a recap, hopefully you guys can read my handwriting again. Conventional. They're definitely the more traditional model. Typically for people with higher credit scores of 700 to 800, okay? They have more consistent income, they've been around longer, they typically have more cash to put down. So again, they have a higher down payment. So for first-time home buyers, that 3%, they could actually go conventional.
They could.
It's interesting.
Yeah, the first-time home buyer rule is you're either a first-time buyer or you have not actually had ownership in real estate in the last 3 years.
Oh, okay.
So it's either or.
That model.
And
Yeah.
you could actually get by with a minimum 3% down.
That's interesting. So here's something that a lot of people don't even know. You can get a mortgage for 40 or 50%. Right? Loan to value. So like, let's just say like, I want to put down 40%. I want to put down 50%. You can still get a mortgage. Like, of course, like you don't have to go to private equity to do that. You can still get a conventional mortgage.
Absolutely. And we see, we see a lot of people, a lot of buyers put a lot of money down, especially if they've just sold a property or something like that. There's not really a limit on how much you can put down and still get a mortgage. Most lenders are gonna, have an issue with doing a mortgage for say less than $50,000 or $60,000.
Sure.
But you could still get a mortgage. I'm always a big advocate for not throwing all of your money into the down payment because number one, rates are not that bad. I mean, they are still in the sixes, but you could get a rate of return on that money that's much higher in many cases versus sinking it all into the equity or into the down payment on your house.
Let's talk about, so since you've been doing mortgages for 33 years, which I did not even know, by the way, that it's been that long. You don't look old enough. Okay, so we're talking about, so as of today, July 1st, 2026, interest rates are in the mid sixes, around sixes,
Correct.
which people are like, oh, it's so high, because again, once we had the twos and the threes back after COVID and during COVID, now everybody thinks six is high.
Yeah.
However, there were people who had 17 and 18% interest rates at one time. Did you ever write one of those?
I did not. That was actually in the 80s. However, when I started out in 93, there were still plenty of mortgages that were double digits, like 10, 11, 12%. And it was really, for the longest time, the average rate was around 8%. And then once 9/11 happened, that is when we really saw reductions down into I remember after 9/11 when rates dropped into the sixes, we were like, oh my God, it'll never be this low again. And that's literally where we are today, is in the mid sixes. So I think the problem ultimately is, and we're all guilty. We all have very short memories on a lot of things, and so the rates of 2 and 3% during COVID, during 2020 and 2021, that was an anomaly. I don't think anybody in our industry expects to ever see that again. But I do want to point this out, and because we talk about rates being around 6.5 as of today. The rates have been ranging between 6 and 7% for the entire last 3 or 4 years. There were times that they got over 7. There was a small window during the first quarter of this year where we saw rates in the upper 5s.
Yes,
and
I remember.
Right. And so a lot of people that had bought houses over the last 2 or 3 years, they were refinancing and, we were congratulating them because they were smart enough to buy previously, build that equity.
Yes.
But that shifts because it's not, there's so many things that drive the mortgage rates. So clearly global events is one of them.
Yes.
And we were riding that wave of upper 5s until this conflict with Iran, oil, inflation, and they have settled down a little bit. I think the highest we got to over the last few weeks was around 6.75. And so we're back into a 6.5% range today. That could change tomorrow, but that's where we are today. And historically, not that bad.
No, you're right. Okay, so that's one thing I do want to talk about in a minute, but let's go back to conventional versus FHA rates and how they compare, because that's one thing that I try to explain to people, and of course, I don't do it justice like you will. So, because people will ask, hey, what type of loan should I go for? And I'm like, well, again, talk to RJ, because there's a lot of factors. Let's talk about this. So interest rate being one of them.
Okay.
Give me a recap.
Okay, with conventional financing, I think most people know this, but it is, with conventional, it is all about your credit score. So the higher your credit score, the lower your rate is going to be for conventional financing. There's just no denying that. The PMI premium will be lower with a higher credit score. if we're looking at rates today, for example, a conventional 30-year fix is around 6.5%. If we were looking at the same thing for FHA, in many cases, these government loans like FHA and VA, the rates are lower.
That was a shift for me too.
Yeah, I would say that, if I'm looking, let's just say it's the same client, same credit score. They'd be looking at 6.5 on a conventional. They'd be a little closer to 6 on an FHA today. But, if again, it would depend on why we were putting them in either place, because it's not just about your credit score.
Right.
It's about a lot of other things. It's your credit score. It is the type of financing you're doing. What type of property are you buying? Is it a primary residence? Is it an investment property? What is your debt to income ratio? All these things play into it, and that is why rates are very specific, or they're very individualized. That's why not everybody gets the same rate.
That's a great point, because actually with FHA, it's something we didn't talk about. It has to be your primary home.
Yes.
Correct? Okay.
Yes.
Because FHA, the rates are a little bit lower right now, which is great, again, government backed. Yep. But it has to be your main house. You cannot have an investment property or a flip or anything else with FHA. Because you pay higher PMI, interest rate might be a little bit lower.
Yeah.
The flip side, conventional, based more on your credit score and how much you're putting down.
Yes.
Correct? And it's going to be a little bit higher, but again, once that PMI is going to fall off quicker.
It will.
Right?
It will. Because then, let's just say that you took those two scenarios and both of these buyers were putting 5% down. Correct. The PMI is eventually going to come off of that conventional loan. Even if you do nothing,
Right.
Once you've built the equity, it will come off of there. The PMI piece of it, a lot of times, let's just say that I'm comparing someone who's borderline credit score, maybe upper 600s, and when we do the math, my conventional rate and my PMI, that total payment oftentimes is ultimately going to be higher than what it would have been on FHA, because FHA is a little more forgiving on the credit score, and the mortgage insurance premium is a set amount. It's the same depending on the amount you're financing, or the loan to value ratio.
Okay, so, and we're here in Greensboro, North Carolina. How do the rates pretty much, do they change? I'm asking this, but I want your answer. If I move to Alabama, if I move to California, what happens to the rates?
Yeah, rates are relatively very similar, across the country. There's little variances there on rates. You'll talk to one lender whose rate may be an eighth of a point lower, but they're generally in the same range. A lot of it comes down to the lender you're talking to, and the key is always to see what you're paying for that rate. Because, for example, let's just say that we had a buyer here in our local market, and they called around and talked to me and then several other mortgage companies in the area. We're all going to be very similar on rates. One of us may quote it just a little bit lower. I may have a competitor that quotes it just a little bit lower. That's why we always advise people, get the loan estimate, see what the charges are for that rate. Typically, and I'm just going to say it, the lower rate typically comes with more fees.
Okay, that is a key point. We're going to talk about DTI too, because oftentimes I have buyers come to me and they're like, oh, I'm pre-approved with Rocket Mortgage. And I'm like, well, what are their fees? And they're like, what do you mean? They didn't say there's any fees. And I'm like, oh, do you have a loan estimate? Nope, I've got an email saying it's going to be 6% and here's my payment, but blah, blah, blah. And I start looking into it and I'm like, oh wait, where's your homeowner's insurance? Where's everything else? Because they're a national, right? They're a national group. They hide a lot of those fees till the very end. Yeah. That's my experience with my buyers.
Well, they have to disclose, but I think you have to consider, most buyers are not buying a house that often.
They're not savvy though. They don't see where it's hidden. That's my point, yes.
Right, they don't, they're getting this pay, they've been told verbally, okay, you're getting this rate, this is your payment, this is how much money you need.
Right.
And a lot of times they'll just gloss over those disclosures that actually break down the fees. But, and that's why we're always really advocating for the client to pay attention to that, because, I won't necessarily call out a particular company, but, we'll get loan estimates from competitors all the time.
Right.
And sure, they quoted the rate just a little bit lower, but the client's ultimately paying thousands of additional dollars in closing cost for that rate, for what really amounts to a nominal drop in the payment.
Right.
Yeah.
So it's really false advertising, which they're not supposed to do. But it's again, thankfully, when you talk to a lender, again, we're in Greensboro, but you want to get a loan estimate. You want to see what you're being charged for that mortgage. You want to see everything, and you want to understand it before, again, you make an offer. And understanding your homeowner's insurance is included, your taxes. We've done videos on taxes and how those change, because it can vary, right? And again, you don't want to get into a house where you can't afford it or your house poor.
Yeah. I actually had, a client, I actually had a realtor reach out about a buyer recently who, I don't remember who the lender was, but it was an online lender. It was not a localized lender. They made an offer on a house. They couldn't reach the lender, shocker. And they just used an online payment calculator.
Yeah.
And
they're not always right.
When it, right, because it's not going to have the accurate, taxes,
Right.
insurance. It's most likely not going to have PMI, depending on your down payment. So she reached out and she said, "Can you look at this? Can you calculate the payments?" And I did, and I'm like, "Yes, that is the payment," because they finally did call him back and tell him. He terminated, and he lost his due diligence money because it was unaffordable. And that should never happen.
No, it shouldn't. It shouldn't. That again, that's why we want you to get pre-approved before you go house shopping. House shopping is so much fun. People think, oh, I'm just gonna go find a house and then I'm gonna get pre-approved.
Yeah.
But there's a couple of things. I had a client this week actually. I talked to him in advance and I'm like, hey, going through a divorce, another one going through a divorce, which happens a lot.
Yes.
And he said he was pre-approved and I'm like, hey, do you have a free trader, which we can talk about in another video. But I'm like, do you know exactly, have you gotten with your lender? 'Cause credit union, unfortunately, couldn't send them to you. But he's like, no, I'm pre-approved. I did something online. Well, went to the house, getting ready to write an offer. And then guess what? He went through the pre-approval process and now he can't buy the house. He can't even get pre-approved.
Yeah.
So we spent a lot of time and he's really upset and I understand that. But that's why we don't want you to go through that emotional roller coaster.
Yeah, it is imperative that you work on a pre-approval prior to falling in love with a house. And also, I just want to point out that there are still a lot of lenders that will just send you a pre-approval letter
true.
based on an application and a credit check.
Yes.
That is not a pre-approval.
Yes, no. And there's still some predatory lending in my experience, which is one of the reasons I appreciate you so much, because you're very upfront and honest about, hey, this is gonna be tough. You don't want to think about this. But let's talk about DSCR, because you were actually the first one who educated me on DSCR.
Sure.
Great options if you're interested in going into the investment.
Yeah, DSCRs are great. DSCR stands for Debt Service Coverage Ratio. It's for investment properties only. And what's great about it is solely based on the average rent for that property covering the mortgage payment. So ideally, you want that average rent determined by an appraiser to be equal to or higher than what the mortgage payment would be. That is literally the predominant qualification for that loan. They are not, lenders are not looking necessarily at your income or your employment or anything like that. The loan is completely based around the property itself. Again, it's for investment properties only, but it's really perfect for people who want to maybe get into investing that maybe don't qualify the traditional way, or maybe they're self-employed and they can't really qualify off tax returns, or maybe they're an investor who, just on taxes, it just doesn't work. So it's a fantastic alternative. And of course, we're huge advocates for investing in real estate. Fantastic program.
Great program. So 20% down?
Typically, yes.
Okay.
And that's even the case if you were doing a conventional investment property purchase.
True.
You would need 20% down. In most cases, we do have a 15% down for investment on conventional loans. However, you pay the price with a higher rate. So 20% down is the norm for investment properties, and that's no exception for the DSCR as well.
Okay, so as a recap, DSCR loans, right? They're called debt service coverage ratios. Typically 20% down, right?
Yes.
They are only valid for investment properties.
Correct.
Okay.
You cannot use that for anything else.
Okay. Your rent must cover your monthly mortgage, but of course all investors want to not only cash flow, they want to make something extra. So what do you, general rule, 10, 15% more?
I would say if you're an investor, ideally, yes, you want that. Does it impair your ability to get a DSCR? No, because they're not necessarily looking at excess cash flow. Okay. They're just looking at that break even or higher point for the rent versus the mortgage payment.
but we both know, having been, been in real estate for so long, that you want extra cash coming in because there's going to be things that go wrong with the homes, and we can talk about those in videos too.
Every property, every day.
Yes. So you
Yes.
want extra cash, but it's not based on your income. So again, if I'm self-employed and my income looks one way because I have a ton of overhead, I can still buy investment properties with these type of loans versus a conventional type loan.
Yeah, and that's the beauty of it. Because so many people that are real estate professionals, self-employed, investors, just all the different self-employed angles. In my experience, it's really hard to qualify somebody off of the tax return because lenders aren't looking at your gross. They don't care if you made $1 million last year. They're looking at your bottom line net profit in most cases. And if you write everything off and the lender is focused on that net profit, then that's more than likely not going to be enough income to qualify you for the loan. That's why something like this is beautiful.
But what's the cap? Because we've talked about the cap before, because I remember asking, I'm like, what if I want to buy 20 different properties for DSCR? Where's my cap?
I think it does depend on the investor. A lot of investors will limit, their exposure to the number of loans they'll give you to around 10. But then there's other investors that will do more. And you can always use multiple investors to have multiple properties.
Oh, interesting.
Yeah,
okay, so
absolutely.
it's somewhat flexible. That's good.
Yeah, the limit really is more of a investor specific. Like a lot of lenders or lending institutions do not want to have just an excess amount of mortgages tied to one particular borrower.
That makes sense, because if something happens, they don't want.
Yes.
They're risking more. Okay. Well, thank you again, RJ. Again, this is RJ Meyerhofer with Rate. He is my preferred lender here in Greensboro, North Carolina. We will put his contact information as well in this video. But if you enjoy my content, please like and subscribe. Contact me via phone, text, email, whatever you want to do. And we'll be bringing you more videos to help you either jump into your first home or hopefully jump into more homes with investment properties too. So have a good day.